It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the certified financial planners on the program. And with me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
Social Security recipients will be receiving a significant cost of living adjustment to their benefits for 2023. But the question is, will this also come with an unwelcome tax surprise? We're going to help you plan ahead and avoid this tax increase, that and more on today's episode.
That's right. I think you're actually going to feel this increase. It's big enough. We're going to get into the details. It's big enough. Yes, we're facing inflation, but this increase is based on the inflation we've had. Lots of people thinking it's going to start coming down, and so we'll see. We'll talk about it, but there's a tax issue we're going to help you avoid. If you have a question, need some help, we're here to help you. You can call or text us, 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com, and then all over our social media, wherever you're at, we are there as well. Search the Wise Money Show, connect with us that way. Okay, so every single year, the Social Security Administration gives recipients an increase based on inflation. It's actually not the CPLI, it's the CPLI-W, which is for urban wage earners, whatever that means. It's a mystery, okay? So they just make it up, okay? But you get a little adjustment based on what inflation was last year, and you get that adjustment to your Social Security for the upcoming year. This year, it's the largest increase in 40 years, but it's going to create some tax issues for many, many, many people. We're going to help you avoid that. Let's first break down the cost of living adjustment.
Well, it was announced, and maybe you've heard by now, that it's 8.7% higher starting in 2023. Everybody's getting that large of a pay increase, and as Mike said, that's the largest we've seen in decades. You have to go back to the late 70s, beginning of the 80s to see anything at this level. But it has been higher in the past. In fact, back in 1980, I believe that's the highest that we've ever seen, and that was 14.3%. And more people are kind of drawing parallels and similarities between the 70s or coming out of the 70s and the life we're living right now. The amount of inflation that we're experiencing. So it's not a surprise to see this number getting up there into those levels that we saw back in that era.
It's pretty fascinating if you were to look at this chart. I'm looking at it right now from SSA.gov, showing the historical cost of living adjustment. Last year, for 2021, it was 5.9% increase. For 2022, it's going to be the 8.7 that Josh mentioned. That's higher than any other year. 2008 was 5.8% going into 2008. That's interesting. It's followed by two goose eggs. No cost of living adjustment in 2009 or 2010. That history, that time period that you referenced, Josh, late 70s, early 80s, it was 6.5%, then 9.9, then 14.3, then 11, then 7. So hopefully we don't see that stretch, because, guys, that means inflation is staying longer and has been even worse than what we've experienced right now.
Well, and that's what the Fed has been saying lately, right? Oh, maybe inflation is a little more stubborn than we thought, or maybe we're going to have to raise interest rates a bit more than we imagined. And that's just comparing to what they said 2 months ago. So, if they're changing their story that rapidly and not getting caught up with inflation, then it may be that we're going to keep on experiencing this for a bit longer, and interest rates are going to continue to rise and so on. And that is why people are looking back to history and saying, well, have we ever experienced anything like this? And yes, we have as a country.
Are you trying to light the fuse, Josh? You get me really upset.
See if I can get you riled this morning.
I saw someone post this, that in June of 2021, the Fed projected that the Fed funds rate right now in 2023, that they expected the Fed funds rate to be less than 1%. Mm-hmm. In June of 2021, just about a year ago, they were projecting the Fed funds rate that they control, by the way, to be less than 1% in 2023. They have been wrong every step of the way, and it's not even close. Okay. Back to cost of living adjustment.
Glad you got that off your chest there.
Yeah, no, I feel worse right now. Probably you feel worse too. The average retiree, their Social Security is $1,680. This increase is going to be on average about $150. You're not average. You're somewhere around there. You're going to want to do that math. So you'll probably feel that. If you're married, that's $300 increase per month.
Yeah, and there's a little like a consolation prize about your Medicare Part B premium. So that goes down from 170 to 164.
Yep.
But that is, if you look at that, it goes down to 164. Just a couple of years ago it was 135.
Mm-hmm. Right.
So this is it's so confusing because if you don't stay up on this stuff and you don't follow it closely, and this is where, if this is a show about financial planning, we're not here to pontificate about what inflation is or what it should be, and should there be a pivot, and should we increase the Fed funds rate, or should we decrease it, monetary easing, tightening, any of this stuff. What we're here to talk about is, okay, if you have more money, and for some people, fixed income means more to them than others, because some people have a fixed income with lots of flexibility, and some people have a fixed income and they're making some really tough choices. Mm-hmm. And I would say no matter where you are in this spectrum, things are changing, and if you're not tuning in right now, you're going to miss an opportunity.
Yeah, right. Okay, so this show is about planning, and so it's not just, hey, this is fantastic, you're going to get a big you're going to get this 8.7% increase in your Social Security. There's actually side effects, or how does that impact the rest of your financial life? Guys, this is the big news. This you have to approach your finances from a comprehensive perspective, looking at all 6 areas. So an increase in your Social Security, what else will that impact? It likely is going to impact your taxes. You first need to understand how Social Security is taxed, and then we'll kind of share what the issue is here.
Yeah, Social Security taxation is maybe one of the most confusing areas of the tax code. And especially as you're transitioning into retirement, you're ready to start drawing Social Security. No one's ever taught you how this works. And so a lot of people get surprised. Some people assume, I don't pay any tax on my Social Security.
Right. They say, it was a tax coming out of my paycheck as I was working, therefore I get it tax-free in retirement.
Exactly. That would make sense, right? But this is the tax code we're talking about. So, but here's the thing. You may also know people who don't pay any tax on their Social Security.
And they might actually tell you it's not taxable, period,
Right.
as if that is the truth and applies to everyone.
Exactly. And so here's what you need to understand. It all depends upon what your other sources of income are. Mm-hmm. There is a crazy calculation. It takes a long form or some fancy software to come up with the number here. But basically what it's doing is it's taking all of your other sources of income, like your interest, and maybe you get some rent, or maybe you draw some money out of your retirement accounts that are taxable. Maybe you work a part-time job in retirement. Add all that up and throw on top of it half of your Social Security. And then we measure that crazy calculation, this interesting number that you come up with. They call it provisional income. They measure it against a threshold, and once that calculation goes over a certain threshold, it's $25,000 for an individual, $32,000 for a married couple, then you have to start counting some of your Social Security on the tax return. Mm-hmm. And the more of that income that you build, maybe you pull an extra chunk out of your IRA one year because you want to buy a car or take an extra vacation or something.
Or life's just getting more expensive, and you were taking $1,500 out of your IRA, and now you say, I need $2,000, I need $2,200 because life's more expensive. All of a sudden that happens, and that's going to change this formula and could mean you now have to pay more taxes.
That's right. So every dollar more that you pull out of the IRA, it may be pulling another dollar of Social Security onto the tax return. And so your tax return changes just because your income does.
Yeah. So essentially, and we're going to break this down even more. I know it might be hard to understand over the radio waves here, but once all of your other income plus half of your Social Security once it goes $1 over that threshold of either $25,000 if you're single or $32,000 if you're married filing jointly. Then for every dollar above that, it essentially is pulling $1 of your Social Security onto your tax return. So every dollar above that is going to cause $2 to be taxed. So we're going to talk about implications and then how you can plan ahead, how you can help manage or even avoid this. We've got that and more coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern Time, every Saturday morning. Also on podcast at the same time. Also on a couple local radio stations at the same time, which is why the content is structured the way that it is and broken down the way that it is. If you're looking for something more direct, more, shorter and applying, but still applying wisdom to your financial life, make sure you hit that subscribe button, turn on notifications, because we drop new content every single weekday. So turn on notifications, and so you're made aware every time we drop new content. You like the content, leave questions, leave comments, share episodes, all that fun stuff. All right.
So I
think that's a fair start to the explanation.
Yeah, I mean, so it's your adjusted gross income plus your non-taxable interest plus half your Social Security benefits.
But that's a bunch of jargon that nobody understands.
I know, but dude, did you hear the words you used? I listened to the words you used, and
provisional.
Provisional. Okay, all right. Let's just do a man on the street interview. Hey, Lindsay, do you know what your provisional income is?
No.
Okay, there we go.
No one does.
He defined it. I thought it was
zero.
good.
Well, he did provision a short description, but it was, I mean, who uses the word provisional?
Nobody. That's why you have to tuck it in every once in a while.
He's so smarty pants.
All right, so let's kind of add to that definition again. Talk about the upper band. Talk about how, up to 50% if you're in this band, and then up to 85% total could land on your tax return.
Mm-hmm.
Blah, blah, blah. And then we'll talk about, well, have they ever increased that 25 or that 32? And now that your Social Security is increasing, are they increasing these numbers? And we'll get into that.
Okay, can I do that? Can I give it a shot?
Yeah.
Okay, compliments only.
All right. No change. All right. Social Security is getting an 8.7% increase for next year. All good news, right? Actually, from a financial planning perspective, there's some planning work that you need to do. We're helping you with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, and then all over social media, wherever you're at. We are there as well. Search the Wise Money Show. All right, so cost of living adjustment for Social Security is 8.7%. You're going to feel it, right? On average, that's going to be about $150 a month increase for next year. Medicare Part B is going down $5. So again, you're actually going to feel this. Your supplement's probably going up in cost. So it's not all, fully going to drop to the bottom line. However, it may not drop to the bottom line that much because of taxes and this weird rule in which you determine how much of your Social Security is taxed. So Kevin, you want to take another shot at this definition?
I'd love to give it a
I
shot.
thought Josh did excellent, by the way.
As always.
So how do you determine if your Social Security is taxable and when and how much?
Well, typically, you're not going to do it. Typically, your tax preparer is going to do it. And it's confusing because if you say my Social Security benefits that I receive are taxable, that for most people, that is a surprise. And most people remember where they were, what day and what time it was when they first learned that. It's that shocking. And Social Security benefits first became taxable back in 1983, 84. But the big one was in 1993. And that was the largest tax increase in the history of the world. And they said, hey, here's what we're going to do. If you're single and your modified adjusted gross income, that doesn't make any sense to anyone, but basically there's a way to calculate your income, and I think there's a couple big things. If you have municipal bond income, which is income that you don't pay taxes on. Mike, don't smile at me. I'm serious. Everyone is tracking with me right now.
I got you.
Okay,
Yep.
okay.
I'm with you.
So if you have bonds that you're not paying federal taxes on that, they still include that in the calculation. You're like, wait a minute, I'm not paying taxes on it. Nope, but it is going to affect the taxability of your Social Security. And then they take your Social Security, and of course, if you're a logical person, you know exactly what they do. They cut that number in half and then add it back. And so you say, what in the world? So here's all you need to know. If you're single at $25,000 of modified adjusted gross income, it kicks in. And if you're married, it's at 32. And if you say, I'm not even close to either of those numbers, you might not be paying taxes on your Social Security, but you want to look at your tax return with your certified financial planner and understand how this works. If you say, excuse me, if you say I'm so far beyond that, it's not even close, you're likely paying taxes on, and I'm just going to say this, all of your Social Security. I know that's not possible because you can only pay taxes on 85% of your Social Security. But I can't tell you the number of times this has been confused, because if I say to someone, hey, 85% of your Social Security is going to be taxed, what they can hear, and it's happened before, that means that of every dollar of Social Security I receive, 85 cents is going back to the federal government,
Right.
which is not true.
That's not true.
It just increases your taxable income and the income that you pay taxes on. So there are all these cut this in half and do 85% of this and these various gyrations. And I would just think, hey, if I'm anywhere in the $30,000 to $50,000 range of income, I'm probably going to be paying some taxes on my Social Security. And if I'm way beyond that, I'm going to probably pay tax on all of it. And if I'm way below that, I probably am not going to pay tax on any of it. And you just want to understand, because it's the most. I always thought when people retire, our clients retire, tax planning will finally get simple. No, once people retire, tax planning finally gets even more complicated.
That is the truth. And it is Social Security that makes it more complicated, because it adds more moving parts. There's unintended consequences when you do pull more money out of your IRA, or you raise rent on your tenants, or you work that part-time job. It all adds more income to the pot, which brings more Social Security into the pot.
It's a pretty short runway, though. I mean, if we're married filing jointly, once that Kevin, I'm going to say you hit the rumble strips there with your driver's side tires. So I think between the two explanations, hopefully that makes sense. But if you're all of your income plus half your Social Security, if you're married filing jointly, once that gets to 32, some of your Social Security starts landing and becomes taxable. Once that reaches 44, I mean, most of your Social Security is going to be taxable, up to 85%, almost all of it, to use Kevin's term. So that's a very small window, about $12,000. That in that window, you go from none of your Social Security being taxed to having taxable income of an extra $12,000 plus a bunch of your Social Security. That could be an enormous tax increase with just a small amount.
That's exactly right. And one of the things you need to understand is that historically, that range has never changed. Right?
This is the issue. So
So I like what you said, Mike, but I'd like to restate it so our fans can understand it. So basically, above a certain amount, every dollar of income that I have is going to bring a dollar of Social Security into the taxable column.
Yeah. Got it.
All right.
Nailed it.
But here's the thing. Back when when taxes were first introduced on Social Security in 1983, about 8% of families paid tax on some of their Social Security. Last year, it was 56%. They were expecting, with modest cost of living adjustments, that 56 would only become 58% by 2030. This is not modest inflation, guys. I'm sure it's gonna go from, 56 to 60 maybe just next year. So here's the issue, this entire kind of planning issue. Social Security is getting a big cost of living adjustment, so that income is increasing. When you apply this calculation, that means more of your Social Security could be taxable. Why? Because that $25,000 of this calculation or $32,000 of this calculation, that's not getting an 8.7% increase. In fact, I haven't looked through all the internet webs, but I don't know if it's ever gotten an increase.
Right.
So they
No, it hasn't.
They increased your Social Security, your cost of living adjustment, right? So they increased that, but as far as the bands or these limits at which your income would need to be before Social Security becomes taxable, they've never increased that. So this is a slight increase of the temperature on that boiling water that the frog is sitting in. Like this is squeezing the middle class. It's increasing taxes in a subverted way.
Mm-hmm. And so the moral of the story is you want to know, because then what the question is, well, what can I do about it? And there are a couple things that you can do about it, but you're somewhat limited, especially if you're 72 or older and you're into required minimum distribution territory.
Mm-hmm. Yep. Well, I mean, so that is the big question. What can you do about this? Are you just stuck, or are there any planning opportunities? I would first recommend that you need to prepare. You need to see if you are going to be impacted by this, and to us that is doing a tax projection this fall. I know we've got a month left to the year, but I would reach out to your taxpayer if you're not doing tax planning with the CFP, you obviously need to get that step in as well. But do a tax projection to see, are you impacted?
Yeah, exactly. Because even if you are starting to have to count part of your Social Security in the calculation of your tax return, it doesn't mean that your tax bill is spiking necessarily. Because there's more to the story. What are your other deductions and things like that? What write-offs do you have to help offset that growing income? Keep in mind also, the tax brackets themselves are going up next year. Mm-hmm. And I went through and I kind of did the calculation. Maybe it's already published somewhere, but it's just a fuzz over 7% increase. Yep. I don't know why the government can't coordinate that. Why is it a cost of living increase over here at 8.7 or 8.6 some years, and the tax rates themselves? Why doesn't the government use the same number across the board?
And your retirement contributions are expanding in some areas by 10%, in other areas 7%. So right, it's completely inconsistent. But yes, you be aware that tax brackets are expanding, so that might help a little bit as well. But you've got to do the planning. You've got to project out, will this impact you, and if so, how can you prepare? If it will impact you, what can you do? We're going to help you with that and more coming up on the Wise Money Show with Korhorn Financial Group. All right.
So that band that you're referring to, I don't even know why that band exists, because all it really says is that by the time you get to the top of the band, you're at 50%.
Right.
And then when you go over that, you're marching towards 85%.
I know, it doesn't make
sense.
sense.
So who cares about the band, right? It's
exactly.
Just where does it start and where do I reach 85%? It just depends on your income. But what a bizarre rule. All right, so we're talking, what are the things you can do about it? If this does affect you, how can you improve the picture, that sort of thing?
Yep.
Okay.
So, and I've got a list there, and then go into how can you avoid this, and then go into if this isn't going to impact you, if you're not on Social Security, what should you do?
So these are your things. It starts with do tax projection, that sort of list.
Yep.
All right.
The
third segment.
I know the crazy. Oh my word! This is all so complicated. Because you say avoid tax on capital gains, and I say, hey, you're in the 12% tax bracket. Take
0%.
Take as much gains as you can. That's probably not grammatically correct, but you know the idea. Mm-hmm. And so you look at that and you say, all right, what do I do?
Yeah.
Because the more gains I take, the more of my Social Security goes from this side to that side.
Yeah. I mean, the answer is both and neither, right? It's planning. You've got to, when you project out through multiple years, yeah, you've got to make a tough decision. And you want a CFP kind of looking at your entire financial situation, saying, okay, yep, here's what wisdom would do.
Yeah.
So, all right, third segment. Social Security is getting an increase. The calculation that determines whether you're going to pay tax on your Social Security is not getting an increase. Therefore, more of you are going to pay tax on your Social Security. How can you plan ahead for that? We're helping you with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn, Josh Gregory. Every episode of the Wise Money Show is on the YouTube channel, as well as a lot of other content all throughout the work week. We're adding content there. So go to YouTube, search the Wise Money Show, and subscribe to it there. Leave comments there, questions as well. We appreciate that. So that's the crux of the issue. It's fantastic. If you're on Social Security, quote unquote, if you're on a fixed income, or if you're age 60 or older, or is it 62? I can't remember. I think it's 60. 62. And you're not drawing Social Security just yet, you're still going to get this increase added to your benefit. But they're not expanding the thresholds at which, well, will that benefit be taxable? So this means more people are going to have to pay tax on their Social Security. What should you do about it? The very first thing is not wonder. Not wonder. I was meeting with someone just recently, and brand new client was coming in and meeting with me and another one of our all-star CFPs, and we're looking at their taxes and owed $11,000 on the taxes. And I was pointing to that saying, are you doing any tax planning? Was this a surprise? Oh, total surprise. How'd that feel? Yeah, I definitely don't want to do that again. Absolutely, right? So we're pointing out this could be a surprise, could impact you. And again, it's not just Social Security. It's, well, why did Social Security increase? Because everything costs more. Okay, well, if you're on a fixed income, and it's nice of you, Josh, to say, well, you might be raising rent, you might have a part-time income. I think that's rare for Social Security recipients. What's most likely is, yeah, I'm drawing more out of my IRA. Mm-hmm. I'm drawing more out of my investment accounts, and therefore I've got more income showing up on my tax return because, you know, life costs more. Well, all of a sudden, even though tax brackets are expanding, so maybe you're going to stay in the 12% tax bracket, it's still, because this calculation for Social Security and whether it's taxable or not isn't changing at all, that means you're going to have to pay more tax on your Social Security.
Yeah, and if we go back to the calculus that you used in the first segment, Mike, you said the average person is going to get $150 per month more. Well, if 85% of that is taxable, then you would say, okay, in essence, I just got $130 a month more to pay taxes on. And then you say, okay, well, I need to make a provision for that on the federal side of life. Depending on the state that you live in, most states don't have you pay tax on that Social Security.
So that's sort of the second action item then. Once you project out, once you do the planning, say, am I impacted? You then need to figure out, well, how am I going to cover the taxes? And it is very, very confusing and difficult to withhold taxes on your Social Security, but you can do it. Yeah. You can do it. There's an actual form that you need to print out and mail in.
And they give you like 3 numbers to choose from, right?
Yes.
10%, I don't know.
I think they've added a couple. So it's 7.5, 10, 12, 22, I think.
But the point is, if the right amount is 17%, that doesn't mean that's one of your options, right?
So you've got to do that math. You've got to figure it out. I mean, the other option is you could increase withholdings on other income. So your IRA withdrawals, you could withhold 20% on those to help cover how much of your Social Security will be taxable.
That's exactly right. And many of you, if you're in retirement, you've gotten into the habit. It's just part of your annual routine. On a quarterly basis, you send a check in to the government, or you maybe pay online, but there are quarterly estimates that you can pay. And this is another one of the ways that you can get fairly precise on how much you want to send to the government based on a tax projection. And so having a certified financial planner and a CPA on your team collaborating and building this tax projection, it allows you to know with not perfect certainty. There's always some uncertainty on a tax projection. It's your best guesstimate as to where you're going to land. But that best guesstimate can really often sniff out some of the surprises that catch people come tax time. And this issue of Social Security is one of the ways that a tax return can swing fairly wildly from one year to the next. Because as you take action in your financial life, as you draw more money out of your IRA, as Mike was saying, you could be having unintended consequences on the amount of Social Security that's counted. And you could go from owing no tax one year to all of a sudden you owe a couple grand the next year just because of some action that you took without first measuring what the tax consequences would be.
I think this is fairly common. I mean, how often have you guys seen this scenario where an individual is, has done a great job managing their lifestyle, their expenses, and they've got cash saved up. And so the first several years of retirement, they're barely taking anything out of their IRA, not much at all, and living mostly on Social Security, maybe a small pension. And then 72 hits, and instead of taking $6,000 total out of their IRA, they now need to take 25 grand out. Right. And all of a sudden, it's not that extra, amount of the IRA that's taxable. That extra amount of their IRA grabs all of their Social Security and makes it all taxable. So what's the math there? 19,000 extra of income that's pulled out of the IRA all of a sudden means $32,000 of more income is taxed, something like that. So that's where doing that proactive tax planning, that multi-year tax projection sounds so geeky, but compared to the other stuff we've talked about today, that probably sounds cool. That's where you can plan ahead to say, well, how could I avoid this? And that's where I want to turn next. Oh, go ahead, Josh.
Well, I was going to say, it's not just avoid the surprise taxation of your Social Security. Yes, we want to avoid that, but you also don't want to miss opportunities. And a tax projection might reveal to you that all of your Social Security is already counted on the tax return. The worst that it gets is 85% of your Social Security could be counted. That's as bad as it will be. And once you've reached that level, any more income that you add to your return, maybe you do a Roth conversion, or maybe you sell some investments at a gain, whatever it is, all that extra income, it doesn't cause more of this Social Security pain. In fact, there may be still some room within the tax bracket that you're in where you want to intentionally raise your income. Right. So it's like the exact opposite strategy of what we were talking about. And that could be an opportunity for you in a given year to pay some taxes at the lowest possible rate, and not let a year go by where you haven't looked at a Roth conversion or raising some of those capital gains, that kind of thing.
I mean, so if you've got your Social Security and you've got a small pension and you're at RMD age, and all that means the majority of your Social Security is going to be taxed, you're already capping that out, but you're still in the 12% tax bracket, may want to do some Roth conversions up to the top of that 12% tax bracket. Because listen, you're going to be in that 12% tax bracket for the rest of your life. Social Security is not going anywhere. Your pension hopefully isn't going anywhere. Your required minimum distribution is required every single year unless they pull the ripcord and say, no, not this year or whatever. So it may make sense to do some Roth conversion. At that point, if you're already in RMD stage, you've got to take your RMD first. Just know that, okay? And you'll probably want to withhold a decent amount of tax on that RMD so that when you do your Roth conversion, you don't need to withhold on that. So, yes, be aware. Do planning to see, is this going to impact you so that you can plan ahead, but then also identify opportunities. Some of those opportunities could be, hey, how can you avoid this altogether? How can you avoid this, getting pinched here, having the middle class squeeze? I mean, one thing you could do is avoid or reduce other income sources. Sometimes, guys, you probably see this as well. Someone's drawing money out of their IRA. Maybe this is before 72 and a half or 72 and a half, before age 72. And they really need $3,000 a month. That covers their basic bills, but they're drawing $4,000 because, that feels a little bit better. I've got a little bit of cushion. Well, if you don't, and there's a little pride of, I'm actually adding a little bit to the savings account every month. Okay, you're drawing an extra $1,000 out and adding it as taxable income, and that's causing more of your Social Security to be taxed. If you don't need it, don't take it.
There's some people that are drawing out of their IRA so that they can give money charitably to their organization that they care most about. Maybe it's their church or another mission of some sort. If you draw that money out and take it to your bank, it's going to be counted as a withdrawal or as a additional income. If you instead send it straight to that charity of choice, then it can be avoided. This is all if you're over age 70 and a half.
Yeah, so qualified charitable distribution, right? So qualified charitable distribution. We see that all the time as well. You know, I've been tithing for my entire life, and so I'm just going to do it the way I've always done it.
That's a huge deal. And you can't do a QCD from your 403B. Because I was just dealing with some clients that wanted to do that.
Yeah.
And I've been extolling the virtues of not having the money in the 403B.
Yeah, got it. All right, so what are some other things that you can do to help avoid this? And then what if you're not impacted by this at all? There's still planning work for you to do. We got that and more coming up on the Wise Money Show with Korhorn Financial Group.
I think we're going to section 4.
Mm-hmm. Yeah.
I think I would start with if you're charitably inclined and you're giving any money, the default value for that after 70 and a half should be a QCD.
Yeah.
And then I would say, or prove me wrong. But really, it really
You can't
makes.
prove you wrong, right? I mean, it has to be. That way.
I don't.
Is there a scenario that you've ever run into where that doesn't make sense?
There's personal preference.
That's true. Some people don't like to give in a lump sum like that. They want to put it in the offering plate every week, kind of thing.
So that is right. So that'd be personal preference. You can do. I have clients that do QCDs monthly. Like they're like, I have a monthly commitment to my church, therefore I'm going to give it monthly, and that's. I actually think, and this is just a small tangent, but giving out of your donor advised fund is fantastic, because you know what you can do now? You can give all of your charitable contributions to your donor advised fund. Now, you can't do a QCD to a donor advised fund.
Right.
But you can do all your charitable contributions to your donor advised fund, and then you can send it from your donor advised fund everywhere. Mm-hmm. So, and think, okay, I give money to my church, and I really want to remain anonymous. You can remain completely anonymous by giving through your donor advised fund, because you don't need a giving record from your church, because you already got it from your donor advised fund.
Nice.
There you go.
Oh, it's awesome.
All right. So 4th segment, we've got a lot of room to run here. Okay?
Giddy up. So we're going to start back with QCD or not?
Sure.
Okay.
Okay. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast wherever you listen. Just search the Wise Money Show with Korhorn Financial Group. Subscribe to us there or follow us there and rate the program as well. We appreciate that. We're talking about right now the great news that your Social Security, if you're on Social Security, is going to get an 8.7% increase next year, biggest increase in 40 years. However, the calculation to determine if you're going to pay tax on your Social Security, that's not changing at all whatsoever. So you got a 5.9% increase last year. You got an 8.7% increase for this upcoming year. And all of that compounds to more people are going to have to pay tax on their Social Security. When you further say life's getting more expensive, so what I'm supplementing my Social Security with, I'm probably needing to draw more out. I would say up to 60% of people are going to pay tax on their Social Security, where a few years ago that was significantly less. So how do you plan for this, and what are some ways you can avoid it? We left off on the QCD, the Qualified Charitable Distribution. Kevin, expand on that a little bit.
So the Qualified Charitable Distribution means I can give money from my IRA directly to a charity, whichever charity I'm so inclined. And if I was going to give $1,000, the $1,000 goes from my IRA at whatever custodian, Fidelity, Schwab, whatever, to that charity, and it doesn't show up on my tax return, which means, because typically what you would do is you take $1,000 out of your IRA, you give it to the charity, it shows up on your tax return, and then it's deducted from your federal if you itemized. If you
Most
didn't,
people don't anymore.
right? And if you don't itemize, then you're going to pay taxes on that. And you say, well, wait a minute, I'm not going to pay taxes on it because I gave it to a charity. Actually, yes, you will. But the sweetener, and this is why I believe the default value for if I'm 70 and a half and I'm charitably inclined, I need to be giving out of my IRA directly to a charity. because if you give directly to the charity, you do not pay federal taxes and you do not pay state taxes. And most people don't spend a lot of time thinking about such matters. But if you give $20,000 a year to your church and you itemize, your federal taxable income will be reduced by whatever your itemized is, but at least including that $20,000 that you gave to your church. Well, that's a below the line deduction, so you will pay state taxes on that $20,000 that you pulled out of your IRA. So this is where it's in there. So there's a little bit of work involved, but once it's set up, and some people say, well, I give monthly to my church. Well, you can set it up to give monthly out of your IRA directly to the church. It's not perfect. So you might look at it and say, well, I understand the concept. It's not for me. But I've not yet met the person where just financially, and we represent your financial life, financially it's better to pull money out of my IRA, let that show up on my tax return, and then write a check for that money to...
Yeah. Let me add one more benefit to the pile for these qualified charitable distributions. And it goes back to what this show has been all about. It's what kind of impact does Social Security have on your tax picture? And when you no longer have those charitable contributions first landing on your tax return and then going to the charity, instead that income coming out of the IRA never even lands on the tax return. That will have an impact on that crazy calculation we were talking about earlier in the show. How much of your Social Security is going to have to be countable on the tax return? The more income you have, the more of your Social Security is going to be counted. The less income you have, the less of the Social Security. So if instead of counting that $1,000 IRA contribution on your tax distribution, thank you, that withdrawal on your tax return, you're reducing your overall income, and it may mean that some of your Social Security no longer has to be counted as well. So it's almost like getting a double tax benefit by doing these qualified charitable distributions. This is the type of thing that gets revealed when you're doing tax projections and you're doing true proactive planning with your certified financial planner. When they ask you about, hey, tell me about some of the organizations that you care about, or I see on your tax return that you've been contributing to such and such an organization. That's because there may be some tax benefits that you could be leveraging if you just change the way that you do your giving.
That's right. That's right. I feel like that deserves an amen or something. Some other ways to manage your income or avoid this Social Security taxation issue. If you've got some dollars in non-IRA accounts, non-tax sheltered accounts, and the market served up some lemons for you this year, like it has for everyone, maybe there's some capital losses that you can capture at the beginning of next year or something like that to help bring that adjusted gross income down. If you are working part-time to supplement your income, if you've gone back to work because, gosh, there's been such a great employment need and costs are going up, that extra income could allow you to make a deductible IRA contribution. Now, do that very carefully because that might feel good in the moment. You get a tax deduction, but it's going to come with a requirement to draw some of that money out. So do planning, but in a unique circumstance, that might help, right? It might be appropriate. So, okay, now let's spend the remaining moments talking to those of you that have suffered through this entire conversation and are not on Social Security. Are there any action items that you should take from this information? Absolutely.
Yeah. And one of the things is if you are involved at all in your parents' finances and your parents are in this sweet spot that we're talking about, anywhere from 62 to 102, I would help them with their tax planning, because I can't tell you the number of times someone has we're working with a couple and they're like, well, I think, my dad needs some help with some things with his finances. It's not complicated at all. And he doesn't even pay taxes. And so you look and dad's doing he's got Social Security. He does his required minimum distribution and he's below the threshold where he's paying federal taxes, but he's got this big IRA.
Yeah.
And you're like, well, someone's going to pay taxes on dad's big IRA. And if that money comes to you, you're going to pay taxes at your rate. What if dad paid just a little bit of taxes over a number of years at a considerably lower rate? Mm-hmm. So I haven't found a great way to say this that doesn't have a shock value, but it's not supposed to have a shock value. The idea is I want you to pay as much as you can in taxes at the lowest possible rate.
Absolutely.
Which means over your lifetime, you'll be paying the least amount of taxes possible.
You know, one of the other principles of financial planning is that we also want you to have as many choices and options as possible. We want more flexibility in your financial life, more avenues or different paths that you can take, especially as you get out there into retirement. And one of the ways that you can help maximize your flexibility and nimbleness when it comes to tax planning is getting to retirement with more than just money in your 401k at work. Building up things like a health savings account if you're eligible, or a Roth IRA, which is a tax-free bucket of money that you could draw upon when you get out there to the Social Security years. And this could be important because you never know when you may have some big major expense that surprises you in a given year. And if you were to pull the money out of just an old 401k or an IRA, it may have those unintended consequences on your Social Security taxation. Like it may be extra painful to pull it from that account. Whereas a Roth IRA is a tax-free place for you to go tap into the resources that you planned ahead for. It just gives you more choice, more options, more planning possibilities when you get to retirement.
Yeah, I mean, we've said this. So what was this now, 40 years? They have not changed the calculation as to how much income you need to earn in order to pay tax on your Social Security. So if you're in your 40s or you're in your 50s, I wouldn't bet the farm that they're going to all of a sudden make it easier for you. It'll probably be worse. In fact, is it a coincidence? Maybe, maybe not, that they first introduced taxation of Social Security after the last time we had crazy surging inflation and the government was in all sorts of hot water. So do planning, even if you're not in the Social Security stage yet. Do proactive planning. It will have immense benefits compounded over your lifetime. All right, that's all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, all of us at Korhorn Financial Group, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.